get to the conversation. Layoffs. As I mentioned the other time, Netflix, Spotify, Apple, Twitter. There's even one about Microsoft getting on the trend soon. That the thing is like Amazon laid off people in their thousands. It's strange to me because you are sending people back into the unemployment market, and it's sad. But we know the situation of things, but then we know that tech companies have money. Well, yes, that is what we've come to know. So why do you think tech companies are affected by this, since they have money now?
Okay, that's a fair question. So I want to start by first, for those who don't know, let me try and explain the business model of tech startups and explain why they are struggling. And then from there, I will go on to the more established tech companies. So the unique thing about the tech startup space is that the business model is slightly different. It's a bit unique compared to traditional industries, right? So in traditional industries, organizations from day one are looking to revenue. They are looking to make revenue, and then in the mid to maybe even short-term future, they are looking to turn over a profit. For tech startups, you need to understand that there's an ideology behind a lot of these businesses where they are looking to improve the human experience by introducing disruptive technology, quote unquote, to make some of our day-to-day life experiences easier, more seamless, right? So these are organizations that are focused on, first of all, making impact. And then second of all, from a numbers perspective, they are really focused on growth. So hyper growth, penetrating their desired market, gaining the market share, showing traction. Traction means the number of people you are able to onboard on your software, on your platform. If it's a fintech, you want to show volumes of transactions. You want to show that people have adopted and embraced your technology and it's having the desired impact. So bearing in mind that they are focused on traction and hyper growth, how do they run their business? How do they pay their bills? So this is where VC funding, that's VC stands for venture capitalists, or PE companies, private equity firms coming. So what basically happens usually is that the founder or the co-founders of a tech startup, they have an idea. They build a product to support that idea. They launch it into the market space. They show some growth or some traction in terms of numbers. And then they start to do pitches to VCs and PEs to raise funding. So the business is then evaluated. So another question people might have is, okay, so if you're not focused on revenue and profit, then how come these businesses are deemed to be so valuable, right? So the value is measured based upon what I spoke about earlier, growth, traction, and what the venture capitalists or investors believe to be the potential of the business. So based off of that, they look at your numbers, what you're doing, they look at your operating model, they look at the market and industry you're operating in, and they do some complex financial modeling and financial analysis, and they come up with a valuation. And based off of that, you are able to raise funding. So the funding might be debt or equity. So debt means that they are borrowing you the money and you're going to pay it back, of course, at an interest rate. And this is important for what I'm going to say later on. Or equity, which means you're giving up a percentage ownership of your business in exchange for the monies they are giving you. Now, because of the economic downturn, the reality is that across the world, in America specifically, and we all know what happens in America filters into other economies, other Western economies, and eventually even Africa and other developing nations. So right now, there's economic downturn, like you rightly mentioned. Inflation is going through the roof. There's food inflation. We all know there's a war in Ukraine, which has affected global supply chain, which has affected price of food items. There's food inflation, there's inflation in other sectors. Interest rates have also gone up. So what this means is that borrowing money is more expensive. Now, remember earlier I spoke about debt financing, right? So borrowing money is more expensive. Investors are a lot more risk averse. They are a lot less forgiving. So if you were a startup that was successfully able to raise money during the pandemic or sometime last year, they are a lot less forgiving if you're not meeting your targets, if you're not meeting the numbers that were agreed, if you're not able to meet up to your obligations. They are a lot less forgiving. They are a lot more risk averse because they are seeing what's happening in the economy. So what this now means is that for startups in 2021, especially from 2022, I beg your pardon, especially from Q2 this year, startups have been struggling to raise funding. It's almost like the party is, let me not say it's over, but it's on pause. So it's a lot more difficult to raise funding, to convince investors to part with their money. So first of all, so tech companies, startups that are not able to raise funding, unfortunately, and like I said, because the business model is not dependent on making money just yet, they find that they are struggling financially. For those who have raised money, like I said, because investors are a lot less forgiving, the economy is affecting them. Maybe if they're not seeing the kind of growth they had hoped, they are also struggling financially. Now, everything I've said speaks to the startup space. So you might be wondering, okay, for more established companies like the Apples, the Netflix, they are not dependent on VC funding now. They are generating revenue. A lot of them are profitable. What's going on? So the economy has also affected them. So if you are someone who pays attention to the stock market, tech stocks have been down between January and May this year. Tech stocks on the NASDAQ, which is an American stock exchange, have gone down about 30%. It's important because the NASDAQ is made, most of the companies that are trading on the NASDAQ are tech companies. About a little over 50% of the companies trading on NASDAQ are tech companies. S&P 500 has been down 20% between January and May. I'm speaking specifically to May because May is when a lot of these layoffs started happening. Coinbase I think happened in June. So what has happened is that stock markets are